And typically by this time you're mapping the trend that's playing out globally. For us, from a financial market perspective, we are into the first quarter of the financial year, and we still need to see the earnings profile for India Inc. Play out with the Q1 numbers being reported in July. How do you combine the global as well as a local outlook in terms of what the markets can do 6 months from here?
Yeah, I mean, I think both global as well as local catalysts seem to suggest significant uncertainty going forward, and hence the sort of volatility we've seen in the market is perhaps here to stay. Given where valuations are, if you factor that sort of potential uncertainty into the valuations, I guess the risks, both from a global and local catalyst perspective, is to the downside, at least over the next 6 to 12 months, particularly given the sort of political environment that we'll head into ahead of the general elections.
Are you of the view that this is not the end of the carnage in mid and small cap stocks, and large cap stocks have potential to decline much more?
Yeah, I think the mid and small caps clearly have taken the brunt of the fall here, and perhaps are a lot more comparable to some of our other emerging market peers, because when I speak to clients investing in global markets, they reckon that at least from large cap index, particularly the Nifty, Sensex or the MSCI India perspective, India hasn't seen the sort of carnage that the rest of the emerging market peers have seen. So much of it has been borne by the small and mid cap space. So to some extent, I guess at the index level, you may not see significant downsides, but maybe stock specific movements can be quite sharp within the small and mid cap space, even from here.
Pramod, the big story today is what's happening with the currency, and while despite the fall, which is 7% for the year, 2% for the month, the Indian rupee has been still more resilient than the pain points in other emerging markets, especially the Turkish lira as well as the Brazilian real. Even so, how much are investors wary of investing at current levels where there's a big price adjustment happening in mid caps? The large caps are looking a bit sideways, and the currency is at near 19-20 month lows.
Yeah, the currency has clearly been an outperformer from our emerging market peers' perspective. Clearly, we are relatively protected on the capital account front. We don't have a large dollar-denominated debt market, so in more ways than one, India stands out as far as the risk from interest rates or liquidity globally is concerned. Risk from Fed rate action. We know the global roll-off is continuing, and that will only suck out more and more liquidity from the financial markets, and hence put more pressure on yields in relatively safe assets like US Treasuries, and that could cause further outflows from emerging markets and further currency effect. And in all this, clearly the closed nature of our capital markets, particularly on the debt side, suggests that we're relatively immune and the currency should be relatively stable. The only risk for the Indian currency stems from the current account side, where we've seen a fairly healthy economy, healthy on the aggregate demand side, suggesting continued rise in imports even on a non-oil and non-gold basis. That could potentially put more pressure on the currency, but net-net, I think we're still better off than emerging market peers, but overall emerging market currencies will still see downward pressure. So that's clearly on the back of the mind of investors looking at emerging markets in general, including India.
What is it that we are staring at a year from now up until the 2019 elections? Do you sense that there's going to be some stability eventually in the currency? What's the call on crude? And more importantly, does one need to temper and, temper our expectations when it comes to equity market returns? And would you say largely the returns, whatever as meager as they would be restricted to the large caps then, and not as much really from the broader end of the market?
I would sense so. I think, given the sort of year we had last year, this was sort of bound to happen. An element of mean reversion is always healthy in the sense that, it allows investors to take a fresh look at the markets and equities. Like I said, given the sort of potential negative catalyst that we're likely to see over the next 12 months ahead of the elections, either in the form of political uncertainty locally or tightening liquidity conditions globally and potential implications of trade wars globally, you can add a few more catalysts to this. I don't think we can expect any more or any healthy returns from the markets from here on. Even at the large cap level, I don't think we have much room for upside. Relatively speaking, I think given the positioning of institutional investors, given these uncertainties, the large caps are likely to remain a lot more stable than the small and mid caps. We've already seen the beginning of those actions where a lot of these funds have moved into defensive positions, particularly from a liquidity perspective, more into more large and liquid names, but also in terms of sectors, more into defensive sectors such as IT and consumer, and even in pharma, for example, you're seeing increasing position build up. So I would suggest overall returns to the market are likely to be muted. Within that, I think the large caps are going to be relatively stable.
There are two factions in the market right now, Pramod. One camp believes that the price as well as the time-wise correction when it comes to mid and small caps is almost nearing its end. And one part of the market believes that large part of the price damage is done, but we're in for a time-wise correction when it comes to mid and small caps, and that could very well last even beyond 6 months. Which camp are you siding with?
Yeah, I think there is scope for both, time-wise and price-wise correction in the small and mid-cap space. We've seen one of the best possible rallies in this space over the last 2-3 years, where we've generated significant returns. Even after the sort of correction we've seen in the last 3-4 months, we reckon valuations are still on the high side. And given the sort of potential sort of impediments to further earnings growth drivers, particularly in terms of commodity price increases and hence the impact on margins, which is sort of dragging down the impact of a more healthy demand recovery that we're seeing in the economy as far as the translation of top line growth to bottom line growth is concerned. That again is a concern for any further upside from here. Having said that, India has always been a bottom-up market. We've been discussing with investors. This correction has created some opportunities in different pockets from a bottom-up perspective, where there are some strong companies which are by and large immune to the macro environment and should start delivering healthy earnings growth. Where if and where the correction has been quite steep in those cases, they always present attractive investment opportunities. But they always remain few and far between on a broader market basis at the index level, either the large cap or the mid cap index level. I don't think we can say that we're pretty much bottomed out.
Okay. Do you see the earnings profile change at all this year? I asked you this question at the beginning as well. What are you pricing in terms of earnings and how are you mapping that with potential returns?
I think in the run-up in the last 3-4 years, much of the stock price appreciation has come through multiple expansion rather than earnings growth. And clearly the markets act ahead of the underlying recovery in earnings of the economy, and in anticipation of this recovery. In fact, this was perhaps the first year we were expecting a reasonable pickup in earnings growth, and that's been sort of halted. I wouldn't say halted, perhaps slowed down, at least compared to expectations, because of the continued pressure on input costs. While we are seeing a reasonable top line recovery, all of that is not translating into bottom line growth because of the margin pressures. So maybe we would have looked at a potential mid-teen sort of an earnings growth for this year. That's been sort of corrected towards, at best, a low double-digit sort of a growth, and that could come under even more pressure if we see further dampening in the macro environment going forward.
Pramod, it's great to have you on the channel this morning. Thanks very much for taking out the time to give us your thoughts.
You're welcome.
Okay, getting in an important voice.